I think this thing pops on here live right away. So I just want to premise this Friday's live feed from New York. I'm going to have a video coming out here shortly on how you guys can identify $500 in your budget by really just looking at some specific aspects of things that everybody has to kind of have in their budget. And what I'm going to do is kind of help you guys understand maybe how to squeeze a little bit harder down on that budget and extract a little bit of money. This was a request of my subscriber audience quite some time ago, maybe a month back or so. Somebody hit me up and asked me, how we can really look at the budget. And it's kind of a constant evolution, of looking at your budget and seeing where you can extract an extra $25 in your budget. I was just talking to my spouse tonight about, how it was we started as an investor, and it's a cool story. Everybody's got kind of a different, explanation, or they remember, when they actually went from a non-investor to an investor. And for me, it was actually selling. I had a Mustang and I sold it for $3,000 and I ended up splitting the profit. Hey, Juan, welcome to the group. Nice to see you. You guys have no idea. I was golfing today in an absolute torrential downpour, but that's how hardcore I am for my group. And it's nice to see you guys. Very good. I'm going to kind of do some of the house cleaning. Again, guys, stay informed. It's probably going to be a Sunday release. I like to release my videos kind of in the early evening on Sunday. So that how to save 500 is going to be a good one. I worked pretty hard on this one. I work hard on all of them, but this is kind of a cool one that you can kind of put to good use, and try to apply in your own financial lives. So very, very cool. Hey, no problem. I just had some killer feedback tonight and I wanted to address it on this live feed. It was a Facebook post that came through, and there was one of my Facebook group members, name's Michael. I won't use last names on here, but if you guys don't mind, you guys know my first name. You can know my last name as well. So don't use it for anything that's illegal, please. But was talking about, I was going through and he was identifying for the group what he had identified in some single stocks and some ETFs. And it was written out with the intention of, don't forget Ferrari. Yeah, no doubt. I may take a small position in Ferrari. I may pick up 10 shares of that. I mean, for a $1,200 position, you got your 10 shares. I looked into it. I think you're absolutely right. It's funny you said that. I actually got on and looked at some of my old favorite Ferraris, from when I was growing up. I mean, that's everybody's dream car, the 308 GTS and the Ferrari Testarossa and all those, man. You can still find them. You really can. But the new products that they're coming out with are just phenomenal. I think they've got a backlog, and you know more about the company than I do. But I think you're right. I looked into it much more in depth when you brought it up. And I think I'm going to take a 10 share position. Why not? Why not? I think you're right. Since its IPO, it's doubled, right? Its IPO price was around $55, I think. I appreciate those recommendations, man. I really do. It's really funny because I am a channel creator, but it has a nice ticker symbol. Yeah, it does. FAST. F-A-S-T, I think. Am I right on that? It's sick how I can pull these ticker symbols out of my head, but and Rolex, yeah. No, I'm mocking my Citizen tonight for sure. I mock that. I'm proud of it. It's all good. I paid $65 today to play golf in the rain with my buddies. That was cool. That was good. Oh, race. That's it. I said fast. Yeah, race. Thank you. But anyway, this conversation that I was having with one of my portfolio group members, they put these picks on there. And I really like kind of being the steward of the group, because I think all too often we fall into this like, my stock is better than your stock, or the stock that you're coming out with is not going to be as good as my stock, or, hey, you need to really look at my stock recommendation. And I tend not to get in that line of dialogue, because I've learned, guys, that it is extremely much more difficult to pick winners in single stocks than a lot of people give credit for. Okay. And what you'll find is, you may talk somebody off of a recommendation. Kraft Heinz came up in the conversation tonight, and they've been obliterated. I mean, honestly, I bought them at the wrong time, but I'm going to wait it out. I'm going to get paid the dividend over the meantime. And Procter and Gamble, Mondelez, some of the staples have really taken a downturn, no doubt about it. But I think from the perspective of being constructively criticizing of this individual who was putting the information on the Facebook group, I named 5 things that I noticed about, the portfolio stocks and the ETFs that were put forward for comment from the group. And I said, with this, it was actually Michael. Michael's in speak of the devil. Thank you. Nice to see you, man. I hope you took some value out of my post back. I wasn't really defending you, but I kind of was a little bit, because I want that group to be productive. And if you were an expert on the stock market for the last 20 years, hey, great. I don't know you personally, but the cool part about that group is that you can throw those ideas into the group and get different opinions. And everybody's opinions differ. Some are more right than others, and that's fine. What I was most proud of, I think, is kind of reading through your stock picks, and they were some of the best quality assets. They were some of the lowest cost ETFs, right? And then I also always throw in the tax protection, wealth preservation, right, through the self-directed account, which I think really gets underappreciated a lot. A lot of the new folks to the channel don't quite have the validation of being with the independent investor channel for that long. So it's a new concept. So you don't have those validations in place to say, hey, I can prove that I went from point A and now I'm at point Z. And in retrospect, it's made all this different. All we have right now is compounding calculators to really show the damaging effect of fees. But what Michael brought up in the group, I thought was a really good example of not always jumping on this, hey, my stock's better than your stock. I just kind of came back with the simple recommendation, not to overexpose, because out of the stock picks that were offered there was probably about, 30 or 40, I guess. I have 20, with a dollar amount that is reflective of what I feel is a good productive. I feel like a lot of people want to own everything when they first start, and it's difficult because you can really run the risk of watering down your portfolio, by trying to own everything at the start. Keep it simple, buy those ETFs, buy 2 ETFs if that's what you want. I saw that you had the Vanguard small cap in there. I could appreciate, and then a diversified index holding. And then I think you had the Vanguard Dividend in the ticker group there too. Start with that. If you want to buy a single stock, start with two or 3 tops. Start with 1, but give yourself a fair shake. You're not going to be able to start, an incredible portfolio with, $5,000 to $10,000. You can set yourself with a really, really good baseline. But again, you just want to make sure that you're being fair to yourself. You're not going to build an incredible portfolio overnight. It should be a project that you continually build over time. So it's awesome to have you in the group, Michael. I took a little time on your response because I really felt like we were kind of focusing on things over here. And I think I wanted to shed a lot of light on what I found about really, really good about what you were trying to do there, and kind of exploit those positives as far as I was concerned. So let me get to some of these questions. I got a ton of people in the group. This is really cool. Hope you had a good week. Looking forward to tonight's live feed. Hit me with your questions, guys. I'm going to be aggressive. I do have topics. I always do. But I tend to try to focus on the questions. How many positions of stocks that you recommend for the portfolio? That's a really good question. That's Nguyen question. So it's relative. It's relative to the amount of holdings. And if you're a beginning investor and you've got $0 to $10,000 to invest, it brings you into a category of being eligible to maybe tax protect some of those dollars to start. And it gives you a great baseline to start in a good passive ETF and start to build up that fundamental baseline that I talk about all the time through a good diversified ETF. Now, $5,000, you might want to start 2 single stock positions if that's what you want. But it's really up to you guys. I don't restrict and say, hey, here's the cookie cutter approach that you have to take. I basically just give you 5 options, and those 5 options are going to range from being a passive portfolio that if you are a new investor, I recommend that you go, because if you're $10,000 or less in a portfolio, you really don't need to be looking at single stock allocation right away. $10,000 in the S&P 500 is going to do you just fine for a baseline, right? You can start those dividend reinvestments. You can start a dividend or a dollar cost averaging program, and you can start adding and building to that. And that $10,000 over time is going to turn into $15,000. It's going to turn into $25,000, right? But if you guys are out there and you're starting with $1,000, I would really look at just building up that cash baseline. You don't have to take that $1,000 and just jump right into the stock market. You can. You absolutely can. What I was saying at the top of the show is when I started my Roth IRAs some many years ago, I sold my first Mustang for $3,000. I split $1,500, and that was my starting amount in each one of them. And I didn't have the money to max fund. I was funding at $25 per account. And I believe I had a mutual fund in one and a mutual fund in the other. And I owned them for years before I even bought my first 2 stocks, which was Kraft Foods. It wasn't Kraft Heinz before, and AT&T. Those were my 2 first stocks that I ever owned. But I think I owned my Roth IRAs for probably seven or 8 years before I actually ever got into single stock allocation, because those mutual funds compounded and they grew. And then when the timing was right to get into single stock allocation, I had the option, or I had given myself the option to do that at that point, right? And that's just what I did. And hopefully I can help you guys kind of keep that earmarked and look to evolve to that part in your portfolio building career sooner than later. That's the whole point of this, right? But it never hurts to have those discussions, right? So how many positions of stock that you recommend for the portfolio? I can tell you I'm managing about $300,000 right now. I have 10 single stocks in each of my Roth accounts, 10, all right? I have one big baseline ETF in one account and one big baseline ETF in the other account, and the other 10 holdings I have of stocks. I do have real estate REITs in the account, and I do have limited partnerships in the account as well. So just to kind of give you guys an idea, I still am going to do my portfolio breakdown for you guys, but I only own 10, and I've got, $300,000 in the account. So it's relative to the amount of holdings that you have. But you don't want to get so watered down in that account, that you're affecting the compounding interest effect on the dollar amount you have in each one of those investment vehicles, right? So you want to be kind of careful not to water down. Furthermore, if you own 40 stocks, guys, chances are you're going to have a few of those stocks really take a nosedive down. I mean, it's just with single stock picking, it's really, really difficult to always pick winners in your portfolio. And if you've got these stocks over here that are performing well for you, and unfortunately you've made a few, mistakes over here, and they're going to happen, then it may affect these appreciating stocks over here. So you got to kind of be careful a little bit. That was an excellent question. And it's a very long question to answer. But it always comes down to kind of your risk tolerance. You need to kind of understand what your tolerance to the market is. You need to get your budget under control. You need to save some accessible cash. I always like to see people start with a funding amount. Don't try to invest in the stock market with $0. Test yourself. Make sure that you can get up to that first $1,000 saved. I did it. I started with 0. I don't come from money, guys. That's the interesting piece, because so I have the ability to remember in my life when I had nothing. Actually, I started in a vacuum. I mean, I started in Hawk with the IRS not once, but twice I got letters, and I had to dig myself out of that hole, and I did it, and I did it successfully. But build yourself up to that starting amount, whether it be $1,000. Once you get there, make a new goal for yourself to get up to that 2,500, right? Maybe you take 1,000 of that and put it into your savings, and you keep that as your side hustle cash. And then you start your investment account with your remaining $1,500. Now you're diversifying. Now you're making that fundamental baseline that I talk about. And you'd be amazed if you guys set yourself up on a plan, how easy it is to follow through with. If it's something that you want to do, it's something that you have to want to do. You can't have somebody like me tell you that it's something that you have to do, because I know that it is, but you have to want to do it. And investing isn't for everybody. It's not. It's really not. No problem for the feedback. Hey, don't forget. Yeah, I'm just reviewing these. Good evening. It's really nice to see you guys. Ryan, any comment on all the news? I know everyone says to ignore it, but I've read articles that say the buy and hold strategy won't work anymore. Yeah, certainly. They're just trying to get a rise, honestly. 75% of the wealth that's been paid out in the stock market has been paid in the form of a dividend, okay? And I just went round and round with one of my really loyal subscribers, kind of hitting me up a little bit, thinking that I'm talking way too much about the value side of the stock market and not talking so much about the growth side of the stock market. And the problem is this, okay? If I've got a new investor and they're just looking to dabble in the stock market, there's really only one way, and one way only, I know, to get a new stock investor involved in the stock market, so they're not going to get burned with a 30% downturn and think that a Facebook is going to zero if all of their money is involved and tied up in Facebook, which is a huge growth company, right? So I have to be very, very careful with the recommendations that I make to new investors, and I won't do it. I won't do it. Value stocks are not stocks. You're not going to buy a stock like Procter & Gamble and get rich on Procter & Gamble overnight. You're not going to buy Johnson & Johnson and get rich over it. But guys, you have to understand the dividends alone in my account last year were $6,500. That was guaranteed money just to own those stocks as a value investor. Now, I did make money on the trading side owning higher growth stocks, and that's fine too. But you have to start somewhere. And I just choose for my new audience to start you on the path more of a passive investor first, then trickle you into value investing, then go ahead and give yourself the ability to get into growth names. I think Facebook has its place in every portfolio. I really do. I think if you wanted to buy a share of Amazon for $1,500, I think that's money well spent. I think it's going to be a stock that pays you off over time. Google, the same way. But am I going to recommend those three holdings in a new person's portfolio with less than $5,000 to invest with? No way. I just won't do it. I would ignore it, but you guys have to understand, it's the new video that I just came out with. It was calling out a lot of the BS. You guys have to understand the mainstream media is releasing all that information for the sheer purpose of money and entertaining you. It's not going to be entertaining at all for them to get on there and give the three specific points that I talk about. They're not going to have anything else to talk about, right? You've got analyst after analyst after analyst coming on CNBC talking about stocks. Go test yourself. Go back and actually see if some of those blah, blah, the garbage at the mouth that they always want to put, they're good at talking. They're really good at talking, but is it legitimate information? I don't know. I think all of it's a lot of for entertainment. That's it. Yeah, so I disagree. I just read an article that showed that timing the market wasn't going to work anymore, or buying the volatility, right? Buying the dips. That was the thing last year. Buy the dips, because every time it dipped, it went directly up afterwards. So that worked in 2017. It's not working for traders in 2018. But again, we're not trying to build traders here. We're trying to build investors. And there is a very, very distinct difference between investing and trading. Very distinct. And I want to build you up to a point where you dabble in both, but we have to be an investor first. And just in closing to that question, Brian, honestly, I'm a working class guy. I really am. And in retrospect, if I look back, I'm 40 years old now. If I look back over my life and think, could I have done it without investing? You know, could I have been in the position that I'm in now, you know, trying to talk to people and get them involved maybe in the stock market a little earlier than what I got involved? Would I be in the position financially that I'm in now? Hell no. Hell no. Right? So I'm a testimonial of somebody that invests and has invested in a lot of incorrect manners. You know, you guys just do what I tell you to do and get yourself into that right account, put yourself into that. I call it the conduit all the time because that's really what it is. It's your plug into the market. It's your plug into the market, and nobody's charging you for that plug in. All right. It's that important. And the quicker you can get those dollars filtered in there and get them paying you, remember that dividend payment? I get paid dividends every quarter. Every now and then, every few days, every week, week in and week out, I'll have a dividend payment. I know that those dividend payments are going into an account where I realize every single dollar of those dividends. And those dividends have a chance every quarter, quarter in and quarter out, year in and year out, to compound on each other, right? So I hope that resonates with you. I really do. The buy and hold strategy, I do both. And this brings me to a really, really good point. You know, at some point, Brian, when you're looking at going from a non-investor or to becoming an investor, not everything is rosy on this side of the house, okay? If you become an investor, you're going to see your money depreciate. You're going to see your money go down. You're going to go through hard times. You're going to go through recession. Now, if you stay over here as a non-investor, you're not going to have to deal with any of this stuff over here. You're not, right? But there are some things over here as a non-investor that are absolutely sealing your fate. You're never going to enjoy compounding interest effect. Never. You're going to never, ever understand the prospects of your money if you put it into the correct program. And that's what a lot of what I talk about is if you can get your money put into the correct program, you're going to set yourself up for planned success over here. You know, a lot of people, they know the importance of compounding. They know the importance of investing, and they get invested in the wrong way, right? And just because their excitement for getting involved in the stock market all too often overshadows, you know, the fact that they're investing in the stock market incorrectly, right? So if we're going to become an investor, we're going to do it right, and we're going to stack more of the chips on our side to make sure that we can realize what we're trying to realize in the future, really. So, you know, it's this teeter-totter effect going back and forth. And a lot of people, man, they'll step into the stock market brand new and they're going to watch their money go down or up. Okay, one of two things are going to happen. It's going to go up and it's going to go down. Let's say it goes up a little bit. And I watch these new investors all the time. It's funny. They want to report back to me and they're just like, yeah, hey, I made $10 a share on that stock that you recommended. You know, it's up $10 a share. I'm up $150. And I don't mean to be rude, but really it's kind of like a so what thing to me. It really is. Like, how long have you been in the stock? 2.5 weeks? That's fantastic. Hey, come talk to me in 10 years when you're up, 1,500, 2,500% in the stock. That's what we're aiming for. I'm not aiming for a short-term gain of 250 unless you put a tradable position on the stock, right? So yeah, I definitely could talk more. Getting some killer questions tonight, guys, and I really appreciate that. That's a great, great question. I don't know. I'd throw that in the BS category, honestly, because I'm a living, breathing representative. And, I don't know if it's so much that the rich people just want to, the fund managers and everybody else, want to basically stand in front of the TV and tell you that you can't do it. You can't do it. And I'm here to tell you that you can do it, right? 2 more doubling cycles and I'm at $1 million, 2 more. That's 14 years, guys. I gave my Rule of 72 video to Scribner to do quite some time ago. I really was not comfortable at all with YouTube. I was just starting out. And I did a collaboration with him. I very much appreciated it, but I have yet to do the Rule of 72 video again for my viewing audience. I do plan to do that because it'd probably be a little bit better delivery now than when I delivered it on Scribner's channel. quite some time ago when the channel was new. Thank you for that question. Very, very cool. KHC is a $90 stock. Yeah, there's no doubt. I mean, it's really been recessed. General Mills, I also put in this category. This comes up a lot, you know, and I'm not saying you take your entire wad and dump it on KHC or General Mills, but is it worth taking a 10-share crack at this right here at $44, guys? 10-share position. I look at the price of a stock in blocks of stock. Okay, so that's kind of how I do it. I don't look at the price of stock and say General Mills is at $44 or Kraft Heinz is just below 60 right now. I think there's $57, right? 10 shares, that's $570 for a beautiful diversified dividend player, you know. And it's like, well, nobody's eating ketchup. BS. The next time you guys are in Red Robin, look on the counter and tell me what your reaction would be if you were sitting at a table with a generic brand of ketchup at your table. You'd lose your mind. You should lose your mind. Every single table in this country has a tub of Kraft Heinz ketchup on it. Why? Because that's what we expect to see. Moat. That's the moat that they have. Yeah, Kraft Heinz is fine. I'm a happy shareholder in Kraft Heinz. I think I'm down about 20% right now. I could care less. I've owned the stock for 2 months. I'm not going to bitch and complain, you know, after 2 months of owning the stock and it's down. You know, I bought it at the wrong time, but I did scale in a small position. I think I've got 30, 40, 50 shares of Kraft, I think. The only buy that I made this week was Amazon and Intel. So that ought to stir up some discussion. I was actually thinking about selling both of them after hours this week. If you guys, when I talk about risk tolerance all the time, exercise your risk tolerance and own a few shares of Amazon and then come talk to me. It's a wild ride, no doubt. It's something else. If I didn't sell it, I woke up this morning and found out that I was down a third of my value as my after hours. Intel did the same thing, but I did pick up 100 shares of Intel this week for your guys' knowledge. And Intel is probably going to go to 70. So it's a good starting position, man. 50 shares, you know, get you in there, get you in the door at $2,500, man. You know, 25, split that in a quarter. That's pretty good. $1,500 at 25 shares. Great mega tech company. I had 20. Yeah, we'll see where it goes. I mean, you know, I'm in it for the long term. Hell, if it doesn't turn around within the next 20 or 30 years, by the time I may need the money, I'll give it to my kids. I don't care. I don't care. You guys will get the pulse from me that I do not care about making an investment in a Kraft Heinz food or a Facebook or a Google for that matter. And I focus specifically on the money. It's okay. I'm going to say something scary to you guys, and I hope it resonates with you. The money piece to it is the last thing on my mind. I could care less about the money right now. I care more about the plan. I care more about the account it's housed in, and I care more about the prospect of someday pulling my money out of that account without the government touching a dime of it. That's what means more to me. Okay, so I take these three things and I lump them into what's called the plan. That's the plan, right? And that's what you guys need to focus on, resonate with. Don't focus so much on the ups and downs of the stock market every day. It's going to drive you crazy. Like, I mean, I monitor it, but I have the maturity enough to monitor it without acting upon it. Just because somebody says, hey, the buy and sell hold strategy isn't going to work anymore. Give me a break. Give me a break. Look at the historical returns on any of your major blue chip companies, man. That's a real eye opener. You know, look at what Caterpillar's done over the life of the company. You know, look at 3M. 3M had a disappointing earnings report this week, but look at the lifetime earnings of 3M. You know, I remember 3M when it was down to 130 a share. I've owned 3M. I've made great money with it, you know. So I used to have 20, now I only have 6. Over diversification is bad. Yeah, I call it overexposure. That's a question from Jason. I appreciate that, man. Overexposure is a tough one, man, because you're always trying to strike that balance, man. You've got your budget and food and gas for the tank, and expenditures for the kids, or, you want to take the spouse out and have a nice meal. You want to have some freaking fun over here, right? And I want you to live life too, right? You don't need to invest every freaking dollar that you have and eat farver beans over here. That's ridiculous. If you like that program, go watch Dave Ramsey. He'll teach you to eat out of a can your whole life. And when you're 162 years old, you'll be a millionaire, I don't do that. I live within my means. I do, but I don't live significantly below my means just because I choose to do so. But the overexposure piece is really kind of it's a twofold answer. If you have, very little to no savings, especially if you have debt, okay? Let's say you have no debt and you have a little bit of cash over here on the side, but not much. Let's say 500. Then your investing portfolio should reflect what you have in your total overall holdings, right? So if you can start account over here and start it with, if you've got $500 cash, start this account with $25. Start it with $25 a month. Guys, I did that. That's exactly what I did. I started with 25 because that's what I had. But so it's relative to all people. Everybody thinks you have to have money to make money in the stock market. Yeah, but you have to start somewhere. And starting from zero is the hardest thing that you will ever do. Making that first $10,000 in the stock market is the hardest thing that you will ever do. I remember the first $10,000 I ever made in the stock market like it was yesterday. That was the proudest day that I ever had, because $10,000 when I didn't have any money was a lot of money. And now that I've got money, $10,000 is still ingrained in my head as being a big amount of money. It's big, but it's not so big that somebody who makes a nominal salary or an hourly wage where they're making ends meet over here on the budget can't extract $25 out of that budget and get that into an investment portfolio over here. And it's relative. It's relative to all people. Who cares how long it takes you? Who cares? What matters is you could initiate this plan tomorrow and go from a non-investor to an investor. And that's a beautiful, beautiful thing. It's a beautiful thing. And in this country, everybody can do it. Everybody. Thank you for touching on that. Overexposure is a tough one. And when I talk about overexposure, man, I hate to see those folks with $0 to rub together over here. They've got $500 or they've got, let's say, $2,500 and they invest everything in the stock market, right? You have to resonate with the prospect of scaling some of your dollars into the stock market, right? And then dollar cost averaging on top of that initial deposit into that account. The quicker you can get yourself from zero to X amount of dollars in that investment account, that's what you're aiming for. So if you can get that $1,000 threshold is kind of a good starting point. 2,500 is the next one. If you can save up 2,500, you don't even have to invest anything in that self-directed. Opening a self-directed account, guys, costs you nothing. Zero. It costs you nothing. It takes a little bit of effort. It takes a little bit of ding, light bulb above the head, right? And you're like, Ryan mentioned the self-directed account. I don't know what that is. Let me Google it and find the answer for yourself. And it's going to be like, wow, if there's something you don't understand, ask me about it. I'll just give you the answer. But to open the account costs nothing, zero. There's no minimum to open up a self-directed account. Open it and start funding it, right? Link your accounts together so you can easily transfer from savings account A to retirement account B. It's very simple, right? Do everything over the computer, transfer it over, and you've got it started. And get into that habit of taking and paying yourself first. Make no mistake about it. Whether or not it's an account A or if it's an account B, you're paying yourself first. And that's a beautiful thing. It's a beautiful thing. But very, very few people want to start that process of identifying that there's more to your financial health than just a savings and a checking account. And I know everybody's got a credit card, so I'm not even going to say that. All right, so let's throw that out. So I'm going to get to Juan O's question. I'm going to scroll down here. Juan's got, God, I scrolled down too fast. I apologize. I didn't know there were so many people on here. Holy moly. I'm sorry, guys. I'm going to try to catch this up here. So let's see. Let's kick up here to Juan. Yeah, you're right. I believe Ryan suggested it's not the best idea to hold both since they have similar holdings. Yeah, VOO also has a dividend payment, obviously smaller. Yeah, I think you're addressing the VTI and the VYM. You really only need one of those ETF. And if you wanted to own, the VTI with a small cap, you could do that. Or you could own the S&P 500, maybe with a small cap ETF. You could do that if that's what you want to do. But guys, these discussions, every one of these options are good options, because I'm not going to tell you to do one and the other one is incorrect. All right. These ETFs are the best in the business. Make no mistake about it. We're talking the right lingo. This is what's going to get it done for you guys. All right. So very, very important. I have a small position of P&G in my Roth IRA. I'm prioritized and add more shares of PG around the low 73 range. Smart. Buy Procter and Gamble. Yeah, I don't buy all the garbage that's going on right now, that staples are being depressed. Margins are being compressed, and price power is a concern. But these concerns have come and gone for Procter and Gamble over the years. It's a stock that I've owned for years. It ran up really, really well into the 90s. I actually took a little bit off the table and started some new positions. I think I'm around a 50 share position in Procter and Gamble, but that's a stock that you'd be proud to own. And these are the times when everybody's beating up a stock. These are the times that you want to objectively sit back for a second and say, wow, I would have owned Procter and Gamble when it was at $96. Look at it here at 73. Maybe I take a crack at it and pick up a 10 share position, $730 at a 3% dividend with a company that has that diversified of a product base. I'm all about it. A really beat up name is Newell Brands. That's another one on my really hot conviction list right now. I'm really looking closely at Newell Brands, but I want to get on to some of these. I went with VOO. What other one do you recommend, Ryan? I got 1979. He's one of my best subscribers. I would honestly get on the Vanguard website. I give the referral link on the Facebook group, but certainly VTI and VYM are two that come up a lot. VOO, of course, is the S&P 500. VTI is the total stock index. It's got some mid-cap exposure within VTI, but that's the ETF with 0.04% ratio. Guys, it doesn't get any cheaper than that. I know there's some folks that go with Schwab, and they've got some ETFs at 0.03, but I just would question the year-over-year return and the quality of those ETFs in a head-to-head comparison with what Vanguard offers. All right. Start with VYM. Thank you. Invincible got back to him. VOO and SPY are gold. I agree. No doubt. They're really good. You can go with SPY. I have no problem with that. It's going to give you your S&P 500 exposure. Does anybody know what the expense ratio is to SPY? You always need to look at the expense as to what you're paying, and it comes in the form of the expense ratio. But SPY performs really, really well, really well. So Jason's posting some good tickers there for you guys. I have a problem with dollar cost averaging. Always hard to choose among my portfolio stocks, and I have only 12 stocks. I buy now always the stock where I'm losing money, but when I'm feeling, that's a tough one, man. Dollar cost averaging and strategic buying, I've talked about in the history of the channel. I've got Inserti coming through with a really, really good comment. And I strategically buy stock. I don't necessarily dollar cost average. And the difference is that you pick a date every single month, and those dollars go into that account and they get bought automatically, no matter what the stock market's doing, whether or not it's up 700 or it's down, it's going to buy on the same date. I actually fund my account January 1 of every single year, so I can get those dollars in there, get them working, and get them dollar cost averaging as quickly as I can, because I want those in the accounts right away. So I don't do the monthly dollar cost averaging per se. I do more of a strategic buying program, which is where I get the accounts funded, and then I'll look at the portfolio. Honestly, my portfolios are approaching 6 figures each. So 5,500 in each really is not that much money in relative terms, to the overall holdings. So 5,500 to me is a new holding in one stock, right? Or it's a beef up on a recessed name. So that is what I try to do. As you allude to in your comment there, I try to pick some of the beat up names and try to add a little bit. I try to make the dollar stretch as far as I can. But like I said, 5,500, in stocks that I've got, $10,000 positions in, really, the money can kind of get spread thin if you're not too careful. And that's why right now, the 5,500 for my foreseeable future is going to go right into the index, right into the ETF. That's going to be my dollar cost averaging. January 1, it's going to go into the index. And then at the year's end, I'm going to look at the year over year performance, and that's the way I'm going to do it. So VYM is high dividends, VOO is not. That's correct. Yeah, I recommend you guys go on the Vanguard's website and check out their listing of products. It's really interesting. Losing the momentum on hot stocks. You could be. That's kind of what you run the risk of when you become, more of a growth type of stockholder. I try to do both. Honestly, guys, I'm not asking for your sympathy, but I bought Google, Facebook, Amazon, Apple. I bought them all at the wrong time this year. I've owned Apple for quite many years, but at least the FANG stocks, I bought them all at the wrong time. It seemed, I bought Amazon and Trump sent out the tweet the next day. That tweet cost me $600, just for one tweet, Do I cry about it? No, because I want to own Amazon. I don't get too crazy about that. How many shares of VOO do you recommend having in my Roth IRA overall, or VTI shares? Yeah, so VTI right now sells for around $137 a share. VOO is up toward approaching $250 a share, and it's relative. If you owned 4 shares of VOO, right, at $1,000, that's a good baseline. Don't underestimate just because you own 4 shares that's somehow not a good baseline. It is. You're gonna add to it over time. So if you have 4 shares, that's awesome. Make a goal to get up to 10 shares by the year's end, or get up to 5 shares, within 6 months. Those are all realistic goals, guys. And if I was talking to you in person, this is what we would talk about, Make a good, achievable goal for you. My job is to say, here's the very best S&P 500. I'll throw SPY in there as well. Here's the very best index fund. Put it in the very best account, or ETF, excuse me. And then you guys can kind of come up with a strategic plan to reach those short and medium-term goals on your own. Right? If you want me to reiterate goals for you, I can, but that's really how it breaks down. What dollar amount do you want to be at? Or I've got guys in my group that are making share number goals, right? To where they want to own 500 shares of Apple, or they want to own X number of shares of whatever stock they're looking to accumulate shares in. They're all good, they're all good goals, and they all work. The idea is that you're building wealth. You're building wealth. You're building a money machine that's going to pay you in the future, and that those dollars are going to be protected. It's really important. That's a killer question. It really is just relative to how much starting cash, and getting out of the starting blocks is so much more difficult, man. You just got to get started, and whether or not it's with 2 or 3 shares, or maybe you let that money build up in that money market account. I know those. The 4 shares of VOO at $1,000, if you can get a $1,500 start on it, that's going to give you 6 shares of the VOO. That's a really good baseline. If you can get 2,500 in there, that's a killer start right there. You're talking about 10 shares in the VOO. That's about as good of starting baseline as I can recommend to you. And then you've got an additional $2,000 to maybe add more to the VOO, or maybe add yourself a couple single stock allocations within that account. You could have that immediately. And that's a killer start to any self-directed portfolio right there. So I've got Julio, longtime subscriber. Good to see you, man. I'm going to sift through here, guys. Try to get to some of these questions I'm new in the stock investing. I was looking at Wealthfront. What is your opinion on Robo? I love it. I think Betterment is really good. I ran a cost comparison analysis on Betterment. I'm not as familiar with Wealthfront, but my it was 0.5%. It was a 0.5% of expense ratio with Betterment. I think it was 0.47. And over the long term of being with Betterment, that was going to cost them $50,000. So they better be providing alpha in excess of what the market can produce to you on a year-over-year basis. So what I mean by that is if the S&P 500 returns 10% and Betterment returns you, let's say 12%, okay, minus the 0.5% of fee, that 1.5 of alpha is worth it. But they have to do it every single year. They can't falter in 1 year where a passive vehicle is going to beat what Betterment can do for you, right? And the thing that I like about the algorithms that are built into these systems, both Betterment and I assume this company that you're talking about at Wealthfront, I'm going to check into that because I think it's awesome. I really do. I mean, algorithms can be built around the momentum and the volatility and the trading tendencies. If you guys kind of look at the market from day in and day out, it usually either goes up or it goes down, right? And human beings don't have the ability to make a decision as quick as a computer, so they can build these algorithms to say, look, when the volume reaches a certain point, let's go ahead and buy bigger volumes of stock. And conversely, when it reaches certain trigger points, they can buy more stock and they can hopefully extract the alpha. The problem is they haven't been around that long. So I really, really want to know what a company like Wealthfront or Betterment is going to do in a severe and volatile downturn, right? And I think a lot of this volatility that's in the current stock market, especially over the last couple of years, is actually because of those machine trading. I think they trigger a lot of those algorithms and they trigger them all at once, and that's why you see some of those severe downturns in the stock market. We've already seen a couple in 2018. That's a killer question. I like them. I don't invest in them, but I do like them, and I'm very curious to the prospect of where that industry goes. I believe Ryan suggested it's not the most idea to hold both. Yep. So I'm cruising through here. Jesus is on here. Awesome. You guys are talking to each other. That's great. Nice, man. Thank you, Jason, for all your input on this group, man. You're hooking this group up. If you're not in, I think you're in the Facebook group. I think I recommend your thumb. It's really small on my screen, guys. So I hear you talking about Roth IRA, but what do you think about a traditional IRA? I make $69,000 per year, and I have around $34,000 invested. A traditional can be really good for you, Julio, because what that's going to do is reduce your taxable income from year over year. It's going to be really good. You're just going to have those lingering caps on the back end of it. Withdrawals are going to be taxed. On the back end, and then you've got the minimum distribution at 70.5 that are going to be required out of those traditional accounts. But traditional accounts are really good. I don't talk about them very often. I'm in a Roth because I've said it many times. I want to cap my tax burden someday at zero, because the way the administrations change from every 4 years or every 8 years, especially, we have a new administration that comes in and just changes everything, right? And I would rather just take my benefit and cap it at zero. That's the biggest benefit that I could ever want. And I'm not so interested in reducing my taxable income. But with you at a salary of $70,000, it could be very beneficial for you to take that tax savings on your taxable income. Most people don't take and reinvest that savings. That's the key, right? If you're reducing your taxable income, take the amount that you're being kicked back by the government, right, in the write-off up front, and reinvest those dollars into your traditional account. That's a great question. I made 49% last year. That's killer, man. That is awesome. Dividends won't do more than 10% if you have time before you retire. Go with growth. Yeah, I mean, listen, it's really, really interesting, man, because if you're talking to a guy like me who does both growth and value, like I can speak on the value of both. I really can. And I think my point when I was talking about the growth and value pitch is when I'm talking to somebody who doesn't know squat about the stock market, I really, really don't want to see somebody get involved with a high growth name and see that take a downturn of 30%, man. I mean, Cirrus Logic, perfect example. I mean, look at Micron. Everybody was talking about Micron going to 100. It got whacked. So what are you going to do? You're going to invest all your money into Micron and then watch it adjust back 30%? You know, you're going to be scared out of the market. And I don't want to do that. I want to build people into the market. You know, investing is about building. It really is. And you can invest in growth stocks, no doubt about it. It just takes a higher risk tolerance to be able to put up the swings in those growth stocks. Again, I go back to the wild ride I've been on with Google, Facebook, and Amazon over the last month. It's been crazy. It's been fun, but it's been crazy. I agree. Yep. Good comments on here, Jason. I really appreciate that, man. Very cool. You actually want to bear market if you got 10 years before retirement? Absolutely. Yeah, absolutely. That's some words of wisdom right there, man. You guys heard me talk about this through 2017, and you had everybody on YouTube who had invested for less than 10 years talking about, wow, this is great. This is awesome. You can invest in the stock market and it goes up every freaking day. Yeah, that was right for 2017. But what happens when the volatility kicks in? You're going to have to rest on the strength of your program, right? Ryan GE had a good earning report. It actually went up 2 to 4 this week. Do you think it's a buy? I have a small position, but I'm not sure how small of a position, Juan. I've got 150 shares of it in it, and you know, I think it's a good entry point. I really do. I'd pick it up here at 14. I would have bought it at 20. You know. I think if you believe in the restructuring and you believe in the strength of their core 3 businesses, aerospace, wind farm. I mean, I'm kind of on the cutting edge of that stuff with my employment, and not to get too deep into that. They're in a really, really interesting niche market, and you've still got 150 billion of market cap with General Electric, and they're going to make money with their legacy businesses, no doubt. I just think they're going through a restructure, so. Buy at a discount. Yeah, amen. That's the key. You got to buy at a discount, man. If you're going to look into growth stocks, you really need to look into the budget sheets and really look at the balance sheets and what you're getting into. You know, make sure that you're not paying too much. Amazon's the only exception to that rule in my portfolio right now. I can't not own it. It's just not in the cards right now. Not going to do it. Bumpy to 5. Yeah, GE, it might take 5 years. No doubt about it. Always reinvest dividends. Absolutely. Yep. You guys got a discussion here. This is awesome. Just bought GE. Good. Yeah, I hope you guys kill it, man. As long as you're holding those dollars in the Roths account, so you know you're making good on those tax protected dollars. Sarah, I've got Sarah's question sticking out here to me. It's kind of cool. Do you ever not reinvest dividends? You know, my plan is to kind of turn off the faucet someday and stop dividend reinvesting, because my goal as a young person, and my advice to anybody out there that's looking to grow wealth, to roll those dividends and capital gains back into the stock. But someday, you know, if I can turn those dividends reinvestment program off and actually just take the cash off the top of it, I kind of already said at the top of the live stream that I'm making a pretty good amount right now just off of my small amount in my holdings. But what if that was able to grow to 20, 30, 40, 50? Maybe I'm at $1 million, you know, 8%, that's your $80,000 right there. And that's tax protected money, you know? So I think my plan is to kind of put myself in a position someday to maybe turn the spigot off on the dividend reinvestment plan and maybe skim off of that money. Remember, it can be paid to me after 59.5, tax free, right? The government can't touch a dime. So let's say if we have a really, really good stock market year, when I'm 60 or 61, I may look to take a lump sum of $250,000 off of my portfolio. I may do that. I may keep it in there and let it ride and then just sift the dividends off of that. But you guys understand the way I talk now is I'm setting up myself for the option to do that in the future. Will it happen? I don't know. I'll know in 20 years. But what you have to do is you have to work as hard as you possibly can now to put yourself in those decisions later on in life. Just like what I did 20 years ago. I put myself, as misguided and misinformed as I was when I started investing, the decisions that I've made 20 years ago have put me in the position that I'm in now. All right. There's nothing wrong with buying IRA now, holding. Personally, my portfolio is Netflix, Boeing, Micron. Yeah, Micron's going to be fine. Intuit, I love all those stocks. They're awesome. Align, they're aggressive. I mean, you got your growth heavy, but I would probably award you a risk tolerance of. I'm talking to Jason right now, and everybody's risk tolerance differs, and that right there is conducive of a risk tolerance on a scale of 1 to 10 of probably a 6 or a 7, and if you can handle the swings in those stocks, that's awesome, man. Yeah, he's got Amazon. That's awesome. I have too many single stocks and just one ETF. That could be, but that's an easy fixable problem. And I say it's a problem. It's not really a problem to own stocks. Remember, owning stock and being an investor is a luxury. So give yourself a pat on the back before you constructively take a step back and say, what is it that I can do to kind of retool my portfolio, man? Those are all good decisions to make, guys. You're going to make mistakes in the stock market, okay? You're not going to be exempt from mistakes over here as an investor. But remember, don't be in the middle, okay? Either be a non-investor or be an investor, but don't be somewhere in the middle. Don't be indecisive about your decision. If you're going to be a non-investor, man, I'll be the first to support you. But if you're going to choose to be an investor, you can't just choose the goods about the stock market, right? You have to choose the goods and you have to choose the bads. And there's things that you can do to mitigate the bad, right? And there's also things that you can do to really kind of ignore some of the good as well. Because when I talked about, some of the goods that are happening, and sometimes people internalize that as the validation that they need to say, I've made the right decision over here as an investor, right? It's really, it doesn't matter. Okay. It doesn't matter in the short term, right? Take a little bit more long-term passive approach to this, guys. You guys got some killer discussions going on tonight, man. This is awesome. Very, very cool. Do you like AMAT and Lamb Research? He's going to say yes. Those are both great companies. Great companies. I have Alibaba and China Mobile. Those are also very, very good companies. I'd like to own Alibaba. I opted to own Amazon instead. I think Alibaba is probably a better stock. You just got to be kind of careful with owning China stocks. That's all. I bought the dip last week and I'm down on both. It sucks. Well, so saying it sucks kind of leads me to believe that that's an emotional response. It doesn't suck. It just means that you didn't buy it at the very bottom, and in growth investing, that happens. It happens. You're never going to pick the low. Hey, Doug, welcome to the group, man. Nice to have you. Nice to have you on board. I'm planning to hold Alibaba till I retire. I think that's going to pay off big time in the future. If you can you need to have the stomach to hold it long term. Okay, no screwing around with these stocks. Just buy them and hold them forever. Don't allow the stock to go up 50% and then you get overzealous and trade out of the position. Okay, that's a stock that you can buy and own forever. It really is. All right, just like a lot of these names that we're talking about. All right. I'm just scrolling through the list here, guys. It's pretty long tonight. This is really good, man. To tell you the truth, I was hoping for a bear market. I bought Apple at 169, and I was hoping it would drop to 150. Shoot, there was folks that were talking about Amazon going all the way down below 1250. It turned around the next day and was above 1500. I just couldn't believe it. CRZO If you guys tell me because I have a lot of ticker symbols memorized, but I don't have them all memorized. So just send me the company name, Doug, would you, please? Not only that, I had a rough round today on the golf course. I hit some good shots, but it was rough, man. So my brain is like at 37% right now. So I hesitated even doing this, but I am glad I did. I'm glad I did. We're making this kind of a Friday thing, and we can talk about stock and investing. Very cool. Man, I just skipped ahead. This is amazing. Good grief. Hey, oh my gosh. I just got a tip for $2, man. That's amazing. Wow. That makes my night. That's awesome. Thank you. Thank you very much. That's very cool. SPY has an expense ratio of 0.09 according to Yahoo Finance. Yeah, that's kind of what I thought. I mean, another way of saying 0.09 is over double. You know? So I did a calculation on VOO. VOO is going to cost you around $7,000, right, to own it over 40 years, right? And you think, wow, 0.04 is going to cost me $7,000. Yeah, that's the math of it. So SPY is going to cost you around $15,000. So over double on the expense ratio to own it for a 40-year time horizon. That gives you that ability, right, to look at that and say, how much is this going to cost me over time? I'm waiting for the CRZO come back. I don't have time to jump on Yahoo Finance while I'm scrolling through these questions here. What stocks are good to keep forever? Hey, Hector. Yeah, I did a video on this, man, and the top 5. And I know I'm getting beat up right now over, Apple. Apple's one of them. JP Morgan Chase, Disney, Procter and Gamble, and Johnson & Johnson. Those are my top 5. Those are the top 5 that I would say that you could own forever, right? But it needs to be housed in the proper portfolio, and you don't need to go out and buy 5 of those stocks without looking at a passive investment fund that you can get involved with. And the best one that they're talking through this list here, you've got all kinds of really, really good ticker symbols on the best ETFs that we're recommending. A lot of them have come up here in this script. So certainly scroll back through and look for your SPY, your VOO, now that you know what it's going to cost you over 40 years. But the VYM as well, and then the VTI. And I'm owners of VTI and VOO. But certainly go on the Vanguard website, and you're going to want to get into the stock ETFs, and you're going to look at the large cap stock ETF offerings, man. You're going to get to see some of those diversified products. You can buy and hold those forever. But certainly the top 5, I've got 20 stocks in my portfolio. I'm going to be doing a portfolio breakdown where I'm telling you guys what it is. And again, my goal is about my plan. It's not about the money right now. It's about the plan. And if my plans financially don't work out in the future, then I'll keep the dollar cost averaging effect going well into my 70s, 80s, 90s if I'm lucky enough to make it that long. And then it'll turn over to my kids and they can keep it going. That's real talk right there. That's real talk. Because I care more about the plan. And if my plan hasn't materialized, I'm prepared to go to the nth degree until it does materialize, right? Thanks for that tip. That's really cool, man. So I can open a Roth IRA and simply find it's say 25 to 50 biweekly and eventually go in and purchase, say VOO. Yeah, it's that simple. The Greenhorn Grill and Smoker is hitting me up. It's really that simple. The 25 to 50 biweekly is just that easy, and the dividend reinvestment program. Those are 2 separate things that are available in that account. And keep in mind, those 2 programs, you have to understand, Greenhorn, on your question there, in a managed situation, they're going to charge you for both of those programs, both of them. They're going to charge you 5.75% on each transaction for, let's say, your $25 or $50 biweekly contribution. And that's why a lot of fund managers will put you into 3 or 4 mutual funds. You don't need 3 or 4 mutual funds, but they're gonna take 5.75% on every transaction in that managed account. It's ridiculous. Same thing with dividend reinvestment. They're going to charge you for that function. And that's all it is. It's just a function. That's all, right? I have my accounts linked. So the 25 to 50 biweekly, I can transfer lump sums over into my account. I can set it up biweekly if that's what you want. But the answer to your question is yes, it's that simple. It's very, very simple. Awesome. You're welcome. Glad to address your question, man. You're just hitting on everything that I do. Ryan, I asked you last week about buying large amounts of shares. Do you feel like it's risky? Again, bought 20,000 of block, bought at 49 cents, went to 66, then went back to 51, made 2,100. You're trading, okay? I tend to kind of keep my dialogue on the independent investor channel geared toward getting people who know squat about the stock market. Maybe they've heard about it and they want to get invested. So I try to turn people into investing before they start doing even like growth investing in way of like Facebook, for example. But, buying stocks there that are probably, less than $1 billion market cap is risky. I mean, you can lose, no doubt about it. And I don't want to tell you that you are going to lose. I'd love to see you go on a hot winning streak, man, and make your millions of dollars and then give me a call someday because I've got some hella business ideas, but it's very hard to do that, man. And if it were that easy to do, like you have there, or to duplicate the success that you've had in trading, then it would be scalable and people would be teaching others to do it. But the problem is, I don't know where these funding sources of these people who are putting large blocks of amount of money and losing big blocks amount of money until they hit that big one, and then they make it, and they're all automatically millionaires. But they try to go and they sell other people on how easy it is to become a millionaire. And I'm not a believer in it. I don't think it's that easy to become a millionaire, especially if you're starting from zero. I know a lot of people will beat me up on that, but I also think that a lot of people resonate with, there is some value in acknowledging that hard work really does pay off. And it's a lot more scalable to teach people how to work hard and work correctly in the stock market than to try to time, a stock like that you can pick up a large block of shares. I'm trying to do it right now. Sea drillers is my trade right now, and it's either going to work out or it's not going to work out. But it's such a small portion of my portfolio, right, that I'm willing to take that chance and put a trade on, and that's what I did. So it seems to be making me money buying in large amounts. Yeah, it can. I just certainly, man, Doug, hear me out. I wish everybody the best, man. I wish that you could get involved Monday in a stock trade that puts you up 7 figures. I mean, I was just having a lunch at work, man. And he mentioned to me that he invested $500 into some French tea, Earl Grey tea that you put rose petals in, and it's made him extremely wealthy. That stuff does happen. It happens. It's just very, very difficult for me, if it happens to me, to come to, 10,000 other people and say, hey, my program is scalable. You 10,000 people can repeat the success that I've had, because that's just not true. I just don't believe it. But you, my friend, if you're making it work for you and you're making money off of it, I'm all about it. Because at the end of the day, this game is about money. And if your program is working for you, that's awesome. You have to understand my program is tailored toward, beginning investors and folks looking to get involved early in their life, safeguard money over the long term, because that program is scalable. Does it reflect exactly what I do now as a 40-year-old? Maybe not. I mean, I'm involved in a self-directed account, but the portfolio advice that I put forward for somebody in their 20s, it's going to be different who has an investing capital of $1,000 or $5,000 or $10,000 to invest, than the strategy that I'm going to deploy, because I've been investing for 25 years. I started when I was 15 years old, So the advice is relative, but man, I wish you all the best. It's good to know you. I love to hear these stories, man. These success stories only validate that you can make a lot of money in the stock market. And that's the bottom line. That really is the bottom line. Yeah. Yeah. No, I know. That's pretty awesome, Jason. I just read your quote there about the $100. Um, you know, honestly, with the compounding effect, man, if you can give yourself 40 years, that's about all you need to get to seven figures, not six. But I also run a scenario, Jason, that you might be interested in on the compounding calculator, and everybody wants to show the same 8% year over year rate of return, et cetera. Over 40 years is going to get you $1 million. The caveat to that compounding effect is that many people run the error of not accounting for expenses over that money. So it's a made up scenario, right? So that $1 million over 40 years with an expense of 3% in a managed account, which the industry average is 3%, is not going to render you $1 million. It's going to render you 400,000. It's going to return back to you 40% of the total overall potential of that money over a 40-year time horizon. And that really is the root of the channel. It really is to teach along those premises to say, look, if we could safeguard that $600,000 on the back end when that compounding effect really is taking hold for you, then how do we go about doing that? And that's really the premise that I teach, is the importance of not just always looking at capital appreciation, but also looking at capital preservation within the account. So really good point. I would argue that you probably don't need 100 years. You probably need, if you've got 50 years, I can get you up into seven figures, and I could probably, as aggressive as you wanted to be, I could probably get you up into 8 figures actually, with the compounding effect, not tinkering with your account, investing correctly and investing early. Honestly, and there's actually parents out there that are wanting to invest for their kids way in advance of them ever turning 18 years old. And that's how you get into the compounding of 50 years plus. That's how you get into some of those scenarios, man. And I'm all about it. Jason's on Doug. Leave the penny stocks alone. Yeah, I'm not one to judge, I mean, if the man can make money, man, I'm all about it. I'm just saying, man, you can get burned. You really can. It'd be really disheartening to drop $20,000 onto a penny stock, because at the end of the day, with value investing, if you drop $50,000 into a stock that gets cut into half, at least you can say you can hold the stock. You've got the option to maybe it's just going through a cyclical downturn, or maybe the sector is getting whacked, and maybe you can just hold the stock and try to weather that downturn until it gets to a more opportune time. So I'm going to get to a couple more questions, guys. I've been going for more than an hour. This was probably the best live feed that I've done. This is just awesome. I thank everybody interacting, especially Jason, Julio. I got Juan on here. Doug, thank you for coming. Julio's on here. Sarah, thank you for your question. That was awesome. Nguyen. Very good discussion. 1979. You guys have been great. I really appreciate it. I'm going to try to close this out and get to the end of this. What do you think about acorns? I think it's a good way of kind of getting the mental conditioning of watching accumulated dollars grow. I don't use acorns, nor do I use Robinhood or Stash. I don't use any three of those, but I think it's a fun way to save money. I think if you guys are into it, I know I talk to a lot of millennials. Technically, I think I fall into the millennial category, or just behind it. I don't know. Everybody always told me I was Generation X, and I don't even know what the hell that means. But if you guys want to get more, more into finances and into saving money, I'm all about acorns. It's fine. I just don't want to see you guys rely on Acorn, Stash, and Robinhood as your entire financial portfolio and house all of your assets with those applications. Do it on a small scale. Do it to build some capital. That's fine. It's fun. Build up 1,000, 2,000, help it save you money. That's fine. That's great. But, certainly go with the larger established brokerage house for your investment retirement accounts. Some TD Ameritrade, Fidelity. I go with Merrill Edge. Vanguard it's okay. For my military folks, USAA offers it as well. But it's just that when you call them, you have to be very, very specific with them about what type of account that you own, because they will try to upsell you if you're not careful. I'm with Merrill Edge. Every time I buy, they charge me $6.99, I believe. Yep, you going from zero to some level of amount, that $6.99 is going to be cumbersome to you. That's why I recommend getting that first $1,500, $1,000, $2,500, maybe even all $5,000 in there, and make your strategic buy maybe on big blocks of ETF at a time. So the dollar cost averaging piece that I talk about, to circumvent that $6.99 fee, I would like to see you guys just allow that $25 to $50 go in that money market account and allow it to build up over a couple months, right? Allow it to build up to, $250, $300, $400, $500, then make that strategic buy, guys. And the $6.99 is a drop in the bucket, when compared to the overall strategy that we're looking to deploy in your account. And when you get up to that $50,000 mark, that's that magic amount to where some of those fees start to go away in that account, and you start to actually make your buy purchases for free. Okay. So we do actually have a goal in mind. Okay. Average Joe Investing has a few videos on acorns. Thank you, Brian. That's absolutely correct. I've actually watched Dave's videos on Average Joe Investing, and he does a really good job. I think he actually uses it so he can be able to speak a little bit more in depth on those applications, as I just don't use them. So M1 Finance, you bet. Yeah, I've got financial information or Financial Investor is another channel creator that uses M1 Finance, and he likes it. He likes the fractional share aspect of M1 Finance. So I'm going to get to the end of this feed. It's kind of at a good stopping place, guys. So if you guys, enjoyed it, man, leave the comments at the bottom. That's really cool. If you guys are new to the channel and you haven't subscribed, if you are all part of my, I'd recommend most everybody. Tim's on here and he wants to say hello. That's awesome. I feel like I know a lot of you guys by just the symbol that comes up, and that's really cool. Really cool. It's good. I think we're building a really good community. Anything we can do to help somebody. I don't want to make somebody feel like they're left out. If they didn't get their question answered, certainly hit me up through email. I try to respond. I'm getting a lot more volume with my email traffic, and I try to be as a little bit more direct and a little bit more accessible through the Facebook group. That seems to be a little bit more easy for me to track all the notifications and stuff I get. So please understand, I do the best I can. I do have a full-time job, and this, quite frankly, is not that. This is a project aimed at helping people. So guys, thanks a lot, man. I appreciate the applause. Yay. This was a really fun live feed. I really hope there was some great topics tonight. I really didn't get to some of my hot topics that I had on my board. That's totally fine. I'll let these guys kind of evolve as they will. I've got Alexander. I'll take his question. That'll be the last one. I got in on some Apple today at near lows. Do you think buying at lows makes a difference over time and buying dips? Yeah, I call that strategic investing, and you want to try to get the stock at the lowest price, certainly, but I don't want to see people beating themselves up, over buying a stock and then having it go down. Very rarely do I ever remember, a stock that I bought and it just goes up right away. Most of the time it'll adjust back a little bit, and a name like Apple, you can't be too disappointed, let that weathering, happen. You can certainly scale some dollars into the position. That way, if it does take a 10% further downturn, you can add more dollars at that time, but certainly you're giving yourself the best gauge as to where your entry point was. And that information is available on your trading platform as well. They show you where your entry point is, but certainly you're going to make your life a whole lot easier if you just buy a company like Apple and never sell it. Never. That's my position. I've owned Apple for years and I won't ever sell it. Ever. And it's going to go to 200 before it ever goes to 100. So I don't really know what we're even talking about. You know what I mean? So you want to just look at that position, get as low as a buy point as you can, maybe buy in a good Dow red day, and that'll give you your little bit better couple basis points of entry on Apple. But certainly, try to strategic buy it, and then as you buy it over time, buy it on red days and buy it on a piece of news that comes out that doesn't mean a piece of difference for Apple. You know what I mean? And then go ahead and inject your shares there. So, guys, listen, I'm gonna go ahead and shut off right now. We're at about an hour and 20 minutes, man. I hope the timing on this is right, but I want it to be a good opportunity for us to get on here and discuss finances every Friday night. I enjoy it. I hope you do. Please stay tuned. Sunday release for my 5 ways to find $500 in your existing budget. That's going to help you guys out a ton. I worked pretty hard on it. If you guys do have, Niall on here. How are you? Nice to see you. That's awesome. But keep tuned for that on Sunday. That'll be coming out. I really appreciate the community dialogue tonight, man. This was the best live feed that I've had. This is the only thanks that I appreciate. Thank you for the tip. The $2 tip, that made my night. That's really cool. I really appreciate that. And thank you so much, guys. I'm very aggressive on making sure that the information that comes across is deployable. It's sincere. If somebody doesn't know the answer on here, we're a really good community of saying, hey, we don't know, but there's a lot of savvy folks on here with a lot of different experience. And that's kind of what makes a team even stronger, guys. Listen, I'm going to sign off. Thank you so much. I'm going to go ahead and post it for future viewing, but thank you to everyone who contributed to the live feeds. Thank you, Isaiah. I appreciate that, man. I will absolutely keep it coming all the way up until my move I've got coming up here in a couple months. I'm going to be heading down to Virginia Beach. So I will see you down there, guys. Thank you so much. Take care and be well. Good luck in your investment future, guys. Later.